Good day, viewers. Welcome to the first dashboard for Global Listed Property for 2024. In today's session, we will be discussing our interest rate expectations for the remainder of the year, as well as sharing some of our key insights that we've gathered from the City Conference that the team attended in Miami. I'm Binette van Wyk, CRO at Catalyst Fund Managers, and this morning I'm joined by Zaman Kabendi, an investment analyst of our Global Listed Property long-only portfolios. Zama, let's get right into it. We know that 2024 started off with this rate cut hype, where many investors were anticipating the central banks across the globe to commence with rate cuts. Now, we know that actually, if we look at the quarter that's just occurred, we know that the central banks have actually not done that. What are your views on this? And how does this higher for longer actually affect the global listed REIT market?
Thank you, Binette. Given that the most recent inflation readings have come in at a premium to central banks' medium and long-term inflation targets, the language that we're hearing from the US Federal Reserve, the Bank of England, and the European Central Bank has leaned more cautious over the last couple of months, and this has effectively tempered that hype that we saw in the beginning of the year for interest rate cuts. Despite the three central banks keeping rates unchanged over Q1 2024, the stability that has been created by keeping rates steady has seen capital raising activity increase in the quarter that far exceeds the amounts that were raised in the comparable period in 2023. The combination of tighter lending standards as well as prohibitively high interest rates in 2023 resulted in lower debt issuances overall in the REIT sector. Therefore, the initial expectations of rate cuts this year gave rise to a lot of hopes that companies would be seeing more favorable debt repricing opportunities as well as reprieve on their floating rate exposure. However, generally, we know that REITs have become more disciplined in managing or avoiding the pitfalls of floating rate exposure by way of hedging strategies, mostly using interest rate swaps and caps to manage that capital risk.
Zama, you and some of the team recently attended the City 2024 conference in Miami in March. I mean, these events are always very insightful. You get to interact with roughly 80 or more management teams, and you're talking about more than 20 odd subsectors, and you get to interact and engage with your fellow market participants. What were some of your key takeaways from the City conference?
While the market still does expect rate cuts for the remainder of the year, a lot of the feedback that we got from our meetings with management teams at the conference intimated that the focus was on sector fundamentals and, in some cases, value-added services in order to drive top and bottom line growth, with the rate cuts sort of featuring as a potential sweetener to earnings guidance this year. The benefit of investing in global real estate is that we get to access a diverse set of real estate subsectors, many of which have secular demand drivers that are less dependent on economic growth. In addition to the demand factors, we often have good visibility over supply growth with consistent reporting over permitting and construction starts data that's available to us. Therefore, given supply and demand dynamic developments over the last quarter, we're able to, and our knowledge on lease structures as well as demographic outlooks in many subsectors, we're able to see where pricing power lies within our coverage universe.
Let's maybe take a moment and focus on two of our subsectors where we've got quite a large overweight position currently in our portfolio. And let's take data centers and strip retail as examples to our viewers. And let's unpack the supply and demand dynamics that we currently see. So starting off with data centers, we know in 2023 that there was roughly a 29 billion investment in generative AI deals, where Amazon, Microsoft, and Google were the largest investors. If you take the city conference, what was the word on the street when they discussed data centers?
So those three tech giants, amongst other players within big tech, are key cloud computing and AI tenants for the data center REITs, that is Equinix and Digital Realty Trust, and they are driving a lot of demand and leasing activity within the sector. In addition to AI, very large-scale global technological advancements requiring high computing power are driving the need for very sizable IT and network infrastructure, which the data center REITs supply. Therefore, going forward, we are expecting a significant increase in supply growth in order to meet this burgeoning demand.
Okay, now let's focus on strip retail. And look, we all know that there's like a very healthy demand right now in the US, but that supply, new supply is almost non-existent due to these tight financial conditions. Now, we know that moderating supply is very supportive of strong rental growth that we see in the strip retail center. Now, there's this misconception globally that all retail is dead. But I think it's important to just explain to our viewers, firstly, what is strip retail? What does this sector contain if we compare that to the average mall that we all know? And then maybe just unpack the demand and supply dynamics regarding strip retail, that sector, in a little bit more detail.
I think we're all familiar with what a mall looks like, but to contrast that to a strip center, a good example of that is Palmyra Junction, which we have here in Claremont, which is an open air structure with a row of stores where there's usually one anchor tenant and a few other non-discretionary spend tenants that offer necessity or convenience-oriented retail for the communities and neighborhoods in which they're located, versus a mall which is usually tenanted by discretionary players that are usually more economically sensitive. Sector fundamentals appear strong within the strips retail sector as a result of a lack of supply that we're seeing in the sector, which is unmatched to many of the other sectors that we look at, including industrial and apartments. Estimates within strips retail suggest that we will be seeing less than 50 bips annual supply growth over the next 5 years, which is a really good indicator of where pricing power could lie in the sector. Therefore, in addition to the supply picture, we see a more positive outlook on consumer health, as well as a subdued concerns over tenant bankruptcies, will result in positive net operating income growth over the 2024 period and a modest acceleration in 2025 as the new tenants that have taken over Bed Bath & Beyond stores following its bankruptcy last year start to pay rent.
Sama, in closing, what are your last thoughts which you'd like to leave with our viewers today? And then last but not least, what's the outlook for the global listed property sector?
The conference gave us constructive insights to assess management teams and their handle on sector fundamentals, as well as the opportunities that they have within their respective sectors. Therefore, we are constructive on the depth and breadth of the opportunity set that we have within the asset class. Our estimated forward funds available for distribution yield is 5.22%. USD as at the end of March, based on strong fundamentals in most subsectors, which underpin a robust earnings growth and dividend yield. We are constructive on the asset class and see value in attractively priced subsectors and stocks within our universe.
Sama, thank you so much for your time and for sharing your valuable insights with us today. Viewers, thank you for tuning in. If you'd like to learn more, please refer to our full Q1 2024 Global Dashboard, or alternatively, please reach out to me as per my contact details below. Thank you and goodbye.